What's up, everyone? It's Scotty with Money Investing. So, this is it. We've got, what, 7 minutes left until the interest rate hikes actually do come out at 2 p.m. Eastern. So, we are literally on time, coming in clutch. I literally just got back from the wedding, absolutely exhausted, but I knew that I had to go live before 2 p.m. Eastern to pretty much go over the Federal Reserve's interest rate hike. And of course, a press conference. We'll see if we can actually live stream it if the connection stays stable. Knock on wood, fingers crossed. So if you can see me and hear me, if the audio and the video is good, just give me a thumbs up. I just want to make sure that everything is working well. And again, the actual rate hike comes out in 6 minutes. We do have the poll right now coming in. So we do have 50 basis points, 25, 75, and then of course 100 basis points. So perfect, everything is good, awesome. So we've got this right here. I've got that open already, December 13 and 14. We're gonna get that rate hike right now. Like I said, we're sitting at 3.75 to 4%. That's the current interest rate. So that's where we are at present. So this is again, markets are expecting 50 basis points for this rate hike. This again comes out in 5 minutes now. I came in like literally as soon as I could to go live for you guys. So I would really appreciate it if you pretty much just like this live stream and also share this live stream if you can with anybody who's interested in the market so that they can join us and they can tune in to take a look at that rate hike live with us. So right now, the probability for 50 basis points is 84%, so pretty much locked in. And considering that we're at 3.75 to 4%, 50 basis points is going to put us our target range at 4.25 to 4.5%. That's where we will be for the target range. So as soon as the statement comes out, the first thing we're going to look for, come down and we'll take the target range. We'll see where this number ends up being, right? If it's at if it's at, what is it? What were we saying? So if we're at 4.25 to 4.5%, then the Federal Reserve raised rates by 50 basis points, right? So if this thing reads 4.25 to 4.5%, 4.5%, then that means we raise rates by 50 basis points. Then of course, if this thing reads 4.5 to 4.75%, that means the Federal Reserve raised rates by 75 basis points. So that's what we're going to look at right at 2 p.m. Eastern in about 4 minutes. This is where I'm going to come to very, very quickly. We're going to reload this. And we're also going to get those projection materials. That's a summary of economic projection. So that is also going to be very, very important for the markets, which again comes out at the same time as the statement from the Federal Reserve. So once again, thank you so much for joining, everybody. I really appreciate it. Thank you so much. And we are live. We are ready. And yes, we do have the France versus Morocco game starting in also 4 minutes. It's crazy. Like in 4 minutes, there's a lot of things coming out. There's the France versus Morocco game starting, kickoff for the World Cup semifinals, and of course we've got the Federal Reserve interest rate hike coming out in now under 3 minutes, which is going to be very interesting. So far, the markets are higher. So Nasdaq's pushing up a little bit over 77 basis points after the intraday sell-off from yesterday. And we got the S&P 500 also actually up 77 basis points. So they're actually both up the same amount. And the Dow Jones also up over 250 points with the 10-year yields pushing past over 3.5%. So we are seeing a lot of momentum across the board for, of course, for the indices and for individual stocks. We're seeing them push higher as well. Excuse me, Google's up a little bit over 73, 74 basis points. Apple right now up 66 basis points. And then we do have Tesla still struggling, down almost 1% with AMD here, also down about 30 and 39 basis points. So we are seeing a little bit of momentum to the upside for overall indices and of course for individual stocks. But of course, Tesla, the big underperformer, it's just really, really done poorly over the last several months here as the markets have continued to push higher. So perfect. Also in 4 minutes, my pizza will be ready, David. That's great. Pizza, popcorn, just get ready because it's about to get really crazy. And right now we're already at 200 votes. Make sure that you do vote if you haven't already. Yesterday, we perfectly got up to as much as 1,000 votes, which was very interesting. So make sure that you drop a like, share this live stream, and also vote what you think the Federal Reserve is going to do when it comes to interest rates in about 2 minutes now. 2 minutes. We're going to find out how much the Federal Reserve is planning to raise rates, not only in this meeting, but also moving forward for the next several years. We're going to find that target range for the federal funds rate, and of course the FOMC members dot plot, which is also going to be very, very important. Markets are certainly pushing higher leading up to this print in about a minute 20 here, which again should be very, very interesting and important for the markets. So let's see, how was the wedding, Caddy? It was great, Kevin. It was really good. I'm gonna post some amazing stories on Instagram later, so if you want to connect with me there, you're more than welcome to. I share a lot of the behind the scenes, kind of like my own personal life. So if you're interested in that, Instagram is the place to connect with me, and of course get access to all the stories that I post over there. Kevin will tell you some good stories that I've posted over the last several months here. So Michael says, was it your wedding? No, it wasn't my wedding. If it were my wedding, I wouldn't be here live streaming right now on the night of my wedding. So, but you never know. You never know. Maybe in the future I am. But hey, 30 seconds left. 30 seconds. Let's do this. I'm going to reload this page as soon as 2 p.m. Eastern hits to get that December read. And we'll, of course, take a look at the market's reaction live and see what's going on. By the way, vote if you can. 15 seconds left. I want to get as much data as possible. Although the probability is very much in line with the market, which is 80% probability for a 50 basis point hike. And in 5, 4, 3, 2, 1, we're going to have to reload this page several times to see if the report has come in. Not yet. There we go. All right, so PDF first. I'm going to go over the statement. So rates 4.25% to 4.5%. Boom. We got a 50 basis point hike. Now I go over to the projection materials, which is the SEP. Let's take a look at the markets coming down a little bit. So NASDAQ giving up on pretty much all the gains has come down to a flat number. We got the S&P also flat. The Dow Jones is still more or less up. But let's take a look at these numbers. Okay, so not a lot of changes there. Although for 2023, we are pushing higher to 5.1%. So 2022, 4.4% was that projection. We are there. We are literally, as we speak, the interest rates have gone up to 4.25% to 4.5%, right? So that's what we were expecting. They went from 3.75 to 4.25, and then from 4 to 4.5. So we pretty much raised rates by 50 basis points. That's what the market was pricing in. However, for 2023, they are now expecting rates to be at 5.1%. That's the big change there. And something that I did mention in my yesterday's Federal Reserve video is that this is going to be very important. I would not be surprised if more and more members, and I promise you, once we come down to the dot plot, there's going to be more members expecting rates to get up to over 5%. And boom, there we go. Like for 2023, and I didn't even look at this. I looked at this with you guys live, and this is just, live analysis. 2023, more members expecting rates to be above 5%. Not a surprise for me, because this is something that we were anticipating. We were expecting the Federal Reserve will do. Markets are selling off on that. I think that's the big catalyst there, is that the Federal Reserve is expecting, more members are expecting rates to be above 5%. If you compare this to the previous dot plot, right, there's a big change. Let me show you what that means. If you come over to the SEP from September 2021, we go over to that PDF, take a look at that drastic difference between that FOMC dot plot, right? This is where the dot plot was for 2023. So this is where we were. And again, if you take a look at this right here and go across, we were nowhere near close to 5%. In fact, majority of members were expecting rates to be between 4.25 and 5%. If you take a look at this and compare it with where we are now, which is going to be over here, right? So look at this, right? Now, majority of members expecting rates to be above 5% in 2023. So that is, what is it? So right now we're at 4.5. For us to get up to 5.1, call it 4.4, we need to see, wow, another 75 basis points. Man, the Federal Reserve is not playing. They're definitely not playing. They're not playing games at all. And boom, there we go. The NASDAQ selling off pretty much this entire candle. It is down about 1.38%. The S&P 500 is down about 1% in this candle. And the Dow Jones has just dropped over 300 points in a matter of just 5 minutes. The Federal Reserve is not playing. I think it was all about that guidance, right? It doesn't really matter what interest rates we're going to do this meeting because we knew 50 basis points, and that's exactly what the Fed gave us. But I think it's more about what the Federal Reserve is going to do. Because if you take a look at their other projections, right, and I'll get to some of the comments that you guys are posting right now because I know I'm just talking right now. If you take a look at some of the other projections, they're pretty much the same, right? GDP unchanged. A little bit of a difference there in 2023, but unchanged for 24, unchanged for 25, right? So pretty stable. Unemployment rate, literally unchanged, right? 3.7 to 3.8, 4.6, 4.4, 4.6, 4.5, 4.4, 4.3. So unchanged. Inflation, 5.6, 5.4. We got a little bit higher in next year, slightly higher next year, slightly higher the year after that. But more or less, it is in line with, what they were expecting previous SCP, which was September. The big difference, though, was over here. That right there, 2023, that 70 basis point increase, that's the big catalyst. That's the big sort of, right here. This was the big sort of headwind for the market. And as a result, it's selling off quite a bit, at least in the 5 minutes. Of course, we got the Fed speech coming up in about 20 minutes or something, where Jerome Powell is going to give us some more context into what they're planning to do and what the main sort of analysis is with this. But, so far, that's what we have. So, all right, I'm going to take a look at some of the comments here. I'm going to end the poll because we are done with the actual stuff here. So, all right, let's see. All right. Where's our Tom Lee version of the chat? Everyone bring out the tequila. The market is getting slaughtered. Yesterday was pump and dump. Yeah, 4.5% is where we are. Alma says, appreciate you making this easy. Thank goodness for stop losses. Squeezed out a few gains before the drop. Appreciate it. Thank you so much. Arif, excellent coverage. Thank you. If I really appreciate it. Can't look at the dollar index, insanely proportional to stocks. Wow, France already winning 5 minutes in. That's crazy. That's insane. That should be that's gonna be a fun game to watch. Although I do want Morocco to actually make history, but I think if there's gonna be a very very good final is gonna be between Argentina and France. I mean, Argentina and Morocco would be very very one-sided. So I think Argentina France would be a very good game to definitely watch. But anyway, take a look at some of the individual stocks here. I mean, Google down 0.5%. Tesla. Man, where do I even start? I feel like this is just every time I have to bring up Tesla, it's like a long sigh, or you just have to kind of like just really. I mean, there's nothing to talk about Tesla right now. EMD down a little bit over 2.5%, selling off, and then Apple also dropping over 1.37%. So, significant amount of selling pressure coming in. Volatility is flat on the day so far, and of course we got indices also dropping pretty heavily at the moment. So that's where we are. Shark says, let's watch the game till power comes on. France already scored, probably submitted by, but whatever. Yeah, so that's where we are. Again, we're gonna have to wait another 24 minutes or so to get Jerome Powell, and of course his speech is gonna be very important as well. But bottom line is that 50 basis point hike, aggressive estimates for next year, at least up to 5.1%. I think this was. Again, this is not a surprise. This is something that the market should have already been pricing in. That's the thing. If you come over to the probabilities section here, this might have changed now, but the market was not pricing in over 5% at all. It was at 4.75 to 5%. The entirety of 2023. So I think the Federal Reserve definitely not playing around when they put down a 5.1% estimate. That means they're going to have to shoot above 5% in order to get there, right? So I think that's the big catalyst there. That's the big reason the market sold off is, because this is the thing that they control. They don't control GDP. They don't control inflation. They don't control unemployment. Those things are just a sort of like a lagging indicator, or those are things that get impacted or get affected by what they do, but they don't control it. Right? What they do control is interest rates. So this is, if they're putting down this as their projection, this will happen, right? There might be some variation of it, and of course projections will change, but higher likelihood that this actually does play through. So 5.1%, I think this big change there was the big number, because if you take a look at their September projection for 2024, they were at 3.9%. So they slightly upped it to 4.1. That's a 25 basis point increase. And then over here also from 2.9 to 3.1%, that's another 25 basis points. So the good thing, the positive thing, or the silver lining in this report is that they are certainly getting up to very restrictive levels faster. Like 5.1% means that they need to do another 75 basis points. Now they can do 75 basis points over the next 3 meetings, 25, 25, 25. They can do 50, 25. They can do 25, 50, or they can do just a straight 75 in the next meeting and just be done with it. In my opinion, I think what they are going to do is they're going to do another 50 in February, and then they're going to do another 25 in the next meeting, and then they're going to call it. So this projection will probably get shifted to this February meeting, another 50 basis point, and then this March meeting, another 25 basis points, and then that's it. Starting May, no rate increases unless inflation gets way out of whack, right? So unless inflation just absolutely goes berserk again and starts accelerating and we're like, double digits, right? Then I think they might have to go crazy again on interest rates. But I think that's my estimate, is what they're going to do is 50 basis points, another 25, hit the 75, whatever's remaining, get up to over 5% terminal rates, and then just call it. So, and then look what happens, right? For the years to follow, we're getting full 100 basis point cuts, right? We're getting from 5.1 to 4.1. Those are big cuts, right? Even if they do 25 basis point cuts, that's 4 consecutive cuts that they're going to have to do to get them down to 4.1%, right? They're probably not going to cut rates by 100 basis points unless there's a severe recession, but we're getting them down to 4.1 and then another 100 basis point cut down to 3.1%. So that's the silver lining there, that we're certainly getting up to higher rates much faster, and this is a little bit higher than what previously market anticipated, but we're also coming down a full 100 basis points very, very quickly thereafter. So that's kind of like the analysis there. Again, let me know what you think. What are your thoughts? I would love to know. We've got over 400 people watching, so definitely let us know. Let us know what you think about the interest rate projections here, the SEP. That was all very, very important data that came out, and the market's obviously selling off on this news. We pretty much got destroyed in that 5-minute period. In fact, if I go actually 10 minutes, that 10-minute candle, the NASDAQ dropped about 184 points. Or in other words, it dropped a little bit over 1.7% in that 10-minute period. Same thing with the S&P 500, pretty much dropped a little bit over 1.3%. And the Dow dropped a little bit over, 400 points. So, yeah, just lots of selling pressure here from the markets. Varun says excessive deflation might stop Fed before February. Yeah, but we have to actually see deflation in the economy before that actually ends up happening. If you don't see any deflation, they're not going to stop on this trajectory to low rates. Yes, they will cut rates as quickly as they can. We can't afford the interest payments on the national debt. Kanan Racer says, I think that's a very good point. I think that's a good sort of a topic of discussion, the national debt, and of course the amount of interest that they're paying every year on that debt. So I think that's something that we need to address and understand from a Federal Reserve standpoint. So the press conference in 18 minutes here, 18 minutes. Let's just run through another poll, and I expect a lot of participation. I expect a lot of involvement in that poll, and I'm going to ask you guys Jerome Powell today. And is he going to be dovish or hawkish, right? Meaning that is he going to kind of calm the markets in the economy and try to really soften the blow, or if he's going to come in full swing, not holding any punches back, and just all hawkish along the way, and just trying to absolutely kill inflation. That's going to be in his mind. So let us know in the live chat, and of course in the poll what you think Powell is going to say or do or talk about later today in about 15-16 minutes here. So dovish or hawkish, Jerome Powell, what are we expecting from today? Again, dovish is just kind of being very, very, of course, pulling back and not being as aggressive on inflation, and kind of understanding how important pausing interest rates and cutting interest rates are. And then hawkish is anything but. So merge Caddy, how will it be how it will be presented in the spreadsheet? So again, I'll update those numbers. So right now we do have the Fed funds rate. I'm actually going to update it right now because to kind of prevent any confusion. So December 31st, right now we're at 4.5%. We're literally on point. This is something we were expecting. Now in February, I'm expecting another 50 basis points. We're going to put this number up to 5%. And then in March, I'm expecting another 25 basis points. So I'm going to put this number up to 0.25%. Now, if and when we get up to this number, this is on the higher end, so you have to understand that there's a range, right? So every time you look at the Fed funds rate, is never like an exact number, right? It's always a range. That's why we get those numbers between 3.75 and 4%, or 4% and 4.25%, right? So there's always a range. So these ranges that I have, like the numbers that I have on the spreadsheet, are the higher end of that range, right? So, for example, the rates today are now as much as 4.25 to 4.5%, right? But the rate that I have over here for December is 4.5%. I only have one number. I can't have a range because I don't want to, create confusion. So instead of putting a range, I've just put that number in, which is the higher end of that number, higher end of that range. So 4.5%, then another 50 is going to put us at 5%, and then another 25 is going to put us at 5.25. Pop quiz, quick question. If 5.25% is the higher end of that range, what is going to be the lower end of that range in March once we get up to 5.25%? What's going to be that lower end of that range for this Federal Reserve federal funds rate, 5.25? What's going to be that number? I want to hear from you in the live chat, just so I want to make sure that I'm explaining this well. Just want to make sure that I'm explaining this well to you guys. So what's going to be the lower end of that range for the interest rate there? Okay, so Iman's saying 4.75, Kevin's saying 5, Eunice is saying 5, lots of people are saying 5. Are you guys sure that's 5? Think again. Are you guys sure it's going to be 5? Lower end of that range? Okay, lots of people are saying 5. Aaron says 5.1. Jeffrey's saying 5. Okay, so you guys are right. It is 5. I just wanted to double check. I just want to trick you guys. But yes, it is correct. It is 5%. It is going to be 5%, the lower end of that range. And of course, the actual interest rate is going to be somewhere in between, right? So between 5 and 5.25%, it's going to hit the Fed's target for 23 at 5.1%. And then I think they're going to keep it there, 5.25, 5.25, 5.25. And I think that's what we're going to see the entirety of 2023, getting to a positive spread faster between the interest rate and of course the CPI. So this is going to be the new trajectory for interest rates for Fed funds futures, at least according to myself, moving forward. That's going to be that number. All right, perfect, awesome, good try, Caddy. Yeah, no, I wanted to just kind of double check, kind of question you guys just to make sure that you're confirmed with that 5%. No, absolutely correct. You guys are right. And that's going to be that range. So 5 to 5.25%, that's where we're going to be in 2023 in order to get the rates up to 5.1%. So I think that's the key there. I think that's what really is kind of tripping the markets today. Nothing really changed. Like I said, unemployment slightly higher, GDP slightly lower, than inflation slightly higher. Nothing really like big changes, but except for interest rates. I think that's what really tripped the markets up from this sell-off. All right, so let me see if there's any other questions. And yeah, make sure that you do vote. Right now we've got a split vote. 45% expecting Jay Powell to be dovish today. 55% expecting Jay Powell to be hawkish. But hawkish is winning, by a decent margin. 55% people expecting Jerome Powell to be hawkish. So hawkish is as pissed off as it can be. Powell doesn't like market rallies, so he will be hawkish, no doubt. Alex says he will be Turkish. JP does not care about his job. He will say whatever he wants to say. Hawkish is trying to be the second coming of Volcker. So yeah, we'll find out soon enough what that outcome is going to look like. So can we expect anything positive from the Fed speech, or is it downhill from here? I think the key positive takeaways are going to be just the questions around when they're planning to pause interest rates. I think that's really what the question is going to be. I think I have a good sense of when they're going to pause. I think it's going to be mostly after March, is when they are going to possibly start pausing rates. But again, let me just see if I can get this to update, right? The Fed funds futures, and if this is okay. So all right, this has been updated. Now this is still showing for December 14th for us to get up to 4.25 to 4.5%. So it hasn't been updated yet. But when it does, I think it's going to be very interesting for us to see what the new projections are. And I think they're going to be more in line with what I have, because the Federal Reserve literally just told us that they are planning to get rates up to 5.1%. So I'm gonna continue to kind of play this a little bit, and as we get closer to the speech, I'll turn this up to make sure the audio and the video as well. And again, I've not really tried streaming so far with the hotspot, because I'm literally using like a small device that's like a hotspot, a Wi-Fi. That's how I'm streaming right now. So if the connection breaks down, then I do apologize. I'll send the link over to all of you guys so you can take advantage of that and you can watch that as well. But no promises if it breaks down. Gabrielle, hey Caddy, what do you think about the Christmas rally? So again, let's listen in on what Jay Powell has to say. But I think the interest rate projection does put water down on this Christmas rally. I think it definitely makes the environment a lot difficult, a lot more challenging for the markets to rally, at the moment, because interest rates, like I said, if they're going higher, we're gonna keep having those issues, right? It's like a problem that the market's not able to fully. It's like the market's in denial, that's what it's been like. We know interest rates going higher is going to affect the market, but it keeps anticipating a pivot. That's one thing the market has right now, is hope. And I think in 2022, all we've really seen is hope has not been a good friend of the market, right? Every time it gets disappointed, it gets destroyed. So I think the one thing the market needs to stop focusing on is expecting a pivot or anticipating a pivot, unless the Federal Reserve actually tells us and gives us the green light, So, but there's no green light from the Fed, only higher interest rates at the moment. So it's going to be a while until we see some light at the end of this tunnel. I know, pretty sad stuff. And yes, Kevin says hope is not a trading strategy. Fully agree. I think that's very true. And I think that's unfortunately what the market has been doing, is it's just expecting or anticipating of pivot, pivot. That is just like, it's not going to happen. By the way, over the last couple of days, my voice is just absolutely gone. Like, I am under the weather so much that I need to go back, and when I go back, man, it's going to be long nights of just absolutely sleeping and just. So everybody, thank you so much for joining in. I really appreciate it. So again, almost 500 people watching. So make sure that you do drop a like, and don't forget to subscribe, and of course share this live stream if you know anybody that's going to be interested in kind of tuning in, and of course watching Jerome Powell and the Fed speech live with us, so that we can also kind of understand what's going on. And again, we'll see if the live stream works. Again, we want to make sure the connections remain stable. There's no lag issues, there's no audio issues, and as long as it's good, I'm going to be here, even though I'm actually exhausted right now. Varun, yes, I've absolutely eaten a lot of golgappas. I've eaten chaat, tikka, like all the traditional like Indian dishes and everything. Like, man, I have really cheated on my meals like so much this last couple of days. But it's all for a good cause. All for a good cause. Yeah, so markets still down. We'll see if Jerome Powell has what it takes to kind of warm the markets up a little bit and start to push higher. But right now, I think there's some momentum down with the interest rate projections that are coming in higher. David, how wild will the swings be when Jay Powell speaks? I'm guessing the S&P from 4,050 to 3,950. That's a 100-point drop, which is not bad. I think that's a very, very normal drop in the S&P 500. So I think I think 100, 200 plus minus swings is very normal when Jerome Powell starts talking. Do you have any plans to buy in the near future? So again, I want to take a look at the earnings first. I think if earnings start to get priced in, I think that's what's really going to be important for the economy, for the market specifically. So once I have a good, clear handle on what the earnings are going to look like, then I'll have a price in mind that S&P 500 needs to come down to this level before I can start buying aggressively for a lot of individual stocks. So like I said, if I am thinking about earnings at 200 and I'm putting a 15 times P multiple, I'm pretty much comfortable to go all in on S&P at 3,000, you know? So that's like the most basic surface level analysis that, okay, if earnings decline next year down to $200 per share, and I think a 15 times P multiple is appropriate on the S&P considering the higher interest rates and inflation. So 15 times P multiple times $200 in earnings per share gives us a 3,000 level on the S&P 500. That's, a 1,000-point drop from where we are right now. That's about 25%. That's like, very, very basic surface level analysis that, okay, I'll be comfortable to buy a lot, and aggressively at 3,000 on the S&P. So Richard says, one Bloomberg guest used your analysis of $200 a share and 15p and predicted 3,000 in the S&P. Really? Did they really? Let me know, Richard, if you have the link. I would love to kind of take a look at their analysis and kind of get some more context as to what they were talking about. But that's interesting. That's interesting. And again, that's, you don't even have to know a lot of the fundamentals to kind of understand why 3,000 is a level or why 3,200 is a level, because as I've already pointed out, at the end of the day, when all is said and done, when all the dust settles, the only thing that matters to the market is earnings. And earnings and the market is just a multiple of each other, It's all math. These numbers are not, made up in thin air, but they're actually calculated very easily. So I listened to that one on Bloomberg Live. I'll keep checking for the link. Perfect. Awesome. Thank you. Make sure if you find it, just please share it. So yeah, there we are. S&P getting a bit of a rejection there. When I went live, this candle was green. This candle was about as green as grass can be. And then as soon as the inflation number hits, the Federal Reserve interest rate number hits, just absolute selling pressure coming in, and we're just now getting rejected here at the 200 SMA, and of course at the lower high as well. Just lots of selling pressure coming through. Oh, Kevin, I like that. It's math, not magic. Oh, that's such a good quote. Man, that's such a good finance or investment quote. It's math, not magic. That's so good. I'm going to steal that, Kevin. I'm definitely going to put that on a t-shirt. Money investing, it's math, not magic. I like that. So, all right, let's see. Yeah, David, I think that's a good point too. I have to say the market is a pendulum. The market will not stop at fair value. It'll be overshoot and then come back. Absolutely correct. I think the market is never fairly valued, almost never, because Kevin says pay $8. How about a free t-shirt for you, huh? With a red mic on it. I'll say it's math, not magic, and I'll put a big red mic at the bottom. David says 100%. But yeah, so 100%, fully agree, because very rarely you'll find the market trade at fair value. Most of the times it's mostly driven by emotions, and that's what drives markets higher and lower pretty substantially. All right, so I'm going to do an audio check. By the way, Kevin, we still have to arrange a meeting because we weren't able to, of course, connect when I was in New York, but I'll definitely see if I can make a trip over there once again. But when I do, I'll definitely connect there. And of course, I gotta give t-shirts to David as well, and a lot of other members and subscribers. So they're in the works. So anyway, I'm gonna do an audio check for all of us, and then once that is done, what I'm gonna do is I'm going to make sure that the live stream is working well. If there's any lagging issues, just let me know. Let me know in the live chat quite immediately if you can, please, so that we can fix it, or at least I can try to fix it. But if it's running smooth, just give me a thumbs up. All right, so just let me know audio, video good, right? If you tell me that, I'll be more updated, and you know, because again, I'm working with very limited resources here. I don't have an external monitor, I don't have a screen, I don't have my Ethernet cable or anything like that. So I just want to make sure that everything is good. So the more feedback that you can give me would be very grateful. I would be very happy. So perfect, perfect. So we'll kind of do that audio check here in about a minute here, because Jerome Powell comes on in about 80 seconds, 90 seconds. It is J Powell time in about 90 seconds. So what I'm gonna do is I'm gonna minimize this. I'm gonna put this out a little bit, and boom, let's do that. So, all right, J Powell is gonna be over here at the top left. I'll put the NASDAQ 5-minute, and then we got the S&P 5-minute over here. All right, we are set. In about 30 seconds or so, it's go time. So when he comes on board, I'll do a live check, audio check. And don't mind me if I actually do remove myself from this, because I'm gonna grab some water, I'm gonna grab something to eat, because it's like pretty late, I'm exhausted. So says you said 80 seconds about 15 seconds ago. Yeah, I mean, it is almost time. There we go. It's 2:30 p.m. Eastern now, so we should see Jerome Powell come in any second. There we go. I'm going to do an audio check, all right? So let me know in the comments. Let me know in the live chat. There's no audio right now, so. But as soon as he starts talking, let me know in the live chat, just so we can know that, okay, it's working well. Come on, J Powell, stop making people wait. You got the whole world waiting right now. There you go. All right, make sure the audio, video good, let me know.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing, and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.5 percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that? And how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP again for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows again that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up and it could move down if inflation data are softer.
Gina.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, that we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation is coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE, core inflation index, is non-housing related core services. And that's really a function of the labor market largely. It's the biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe. Yet it's really approaching stall speed. 0.5 percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a 0.5 percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick?
Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's SEP?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately. And that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation. So that's why that goes up. And that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
It's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
And we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy is having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down, I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
So you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. And China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber, Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really, this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael.
Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So I think I got your question. So, one thing is to say is, I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient. We think sufficiently restrictive. We laid out today what our best estimates are to get there, it boils down to how long do we think this process is going to take. And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I would say this, to the extent we need to keep rates higher and keep them there for longer, and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not, and if we do, whether it's going to be a deep one or not. It's not knowable, and certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of so I would put it this way, of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Ryan.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will. We're certainly highly committed to do that.
Grady.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're gonna keep our inflation target at 2%, and we're gonna use our tools to get inflation back to 2%.
Nicole.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored, and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations in inequality? Are you monitoring them?
We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Nancy.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. Where you're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high, nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Greg.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that? Talk a little bit more about that. And really, are you talking about getting Congress action on increasing legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned, if you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually, it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is, and that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because they gave us a job, and we need to do that job.
Thanks. Jennifer?
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No, I mean, what we do is we make our forecasts and we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things, but that's just upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you're reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course, that's something that we know and we'd see. But as I mentioned, that we wouldn't, I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of, for cutting rates, I think in the event, it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
All right, everyone. So that was it. That was the 50-minute speech. I think overall it was kind of neutral. I think there were some little bit of hints of him being very hawkish, at the same time kind of hinting that they are looking at, slowing down, significantly on the rate increases moving forward. And we have certainly front-loaded the rates. I think that's a fact. I think they have certainly front-loaded the rates to a point where they are getting very, very close to being restrictive. But bottom line is they're not restrictive. So, Jerome Powell mentioned time and time again, we're nowhere near close to restrictive yet. And that as a result, they have to still keep raising rates by 75 basis points. The labor market's still very tight, shortage of demand, shortage of workers. There's just a lot of imbalance between demand and supply of labor. But overall, inflation is trending lower, but one data does not make a trend. There's a lot to digest from that speech. I'm not going to be able to do that all tonight because you guys already caught me sleeping a couple times. It wasn't because Jerome Powell was boring, but it's I've had a long day. It's like almost 2 in the morning here. So again, thank you so much for you guys joining in. I really appreciate it. That's gonna be it for tonight or today, this afternoon. I'm gonna post some updates later, but make sure that you drop a like. Market's flat, not really moving that much. S&P is slightly down 33 basis points. Nasdaq's down 37, so we did kind of sell off here. Then we rallied a little bit, and then we're just coming off once again. So thank you so much for tuning in. I really appreciate it. And as always, happy investing. Make sure that you drop a like. I would really appreciate it. And of course, subscribe to the channel if you are interested in, of course, our fundamental and technical analysis. And the links to our Discord and Patreon is going to be down below. 16% discount that's still available. And the fundamental and technical analysis courses is 60% off until Christmas. If you want to take advantage of that, that's going to be the first link down in the description below. And that is going to give you 60% using the coupon code Christmas60. As always, happy investing. Have a good night. And I'll see you all in the next video.